Hey, hello, everyone. It's September 9th, 2022. Welcome back to Finance Friday on the ARC UK YouTube network. I'm Hard Money Jim, back after a 2-week break. I'm here in Jackson Hole, where the morning air is getting sharp as fall is rapidly approaching and football season's back. So Sundays are going to start to get a little more rowdy. And with the US midterm elections coming up, fall is also political season, and practically everything our political candidates say and do, especially during an election season, is designed to convince you to vote in their favor in the upcoming election. And that is the case with the main topic that we're going to discuss today, the Joe Biden Student Loan Forgiveness Program. Now, this proposed program has caused a lot of controversy and a good bit of public outrage. And I got several requests to discuss this deal, so we're going to go into it today. Now, just to bring you all up to date, for those of you who may not have followed this story, on August 24th, Joe Biden announced a major debt forgiveness program that would be a big windfall to millions of Americans who have outstanding college loans. The move, in my view, is clearly a pre-election ploy to gain votes for the left, and these hoped-for votes would mostly come from the left, probably including the apathetic left that might not otherwise vote. Whether this idea will succeed in getting more votes for the Democrat Party remains to be seen. But here at Hard Money Jim, we are most interested in money creation and its consequences. And one of the main reasons for looking deep into money creation, as we try to do, and a good reason to understand it, is so that we can understand how government officials exploit the money creation system to get what they want. Our banking system was designed to leave money creation in private hands, in the hands of private bankers, who hopefully create money by making productive loans. But this system is becoming increasingly perverted and exploited by various government actions. Most fundamentally, the government uses our money creation system to divert real wealth away from unknowing citizens and into spending programs favored by government politicians and their cronies. And today we're going to talk about how exactly that has happened in the government-dominated student lending program. So I want to look at this student loan bailout from several angles, but one important angle will be from the perspective of creation. And we're going to ask, where does the money come from that supplies college loans in the first place? And when those loans are forgiven, where does the money come from to pay off those loans? And so in preview, what we're going to see is that the actual financial impact of the Biden loan forgiveness program, which amounts to like $300 to $500 billion spread out over 10 years, is actually fairly small compared to the giant federal budget that is now over $7 trillion per year and growing. So if it's low financial impact, why is it such a huge topic of interest? Why does forgiving a few college loans cause such a strong reaction, even from some of Biden's very own left-wing allies? Again, in preview, I think the main reason for the strong public interest is that this forgiveness program, which is just a bailout of a lot of people's personal debt, strikes most people as blatantly unfair. And we're going to see why. So so we all can get on the same page and proceed here. Let's just sort of structure this discussion by looking at 4 related topics that are going to help us make some sense of this controversy. First, I want to go into a brief history of the government involvement in student loans in the USA. Just enough history to get a sense of how the government's role has developed and how big this program has gotten and how many people it affects. And second, we need to understand the basics of the Biden proposal. And it is just that. It's a proposal And although he has signaled a strong intention to forgive a lot of loans, it's far from clear that what he is trying to do is legal and will withstand a court challenge. The third thing we want to ask is this loan forgiveness program inflationary? And we need to ask this because this is the main basis on which the forgiveness program is being questioned and opposed by the right. But as we're going to see, the right's opposition to, opposition on inflationary grounds is only a small part of the reason that I think we should oppose this proposal. Fourth, and finally, we need to discuss the most fundamental problem with this program, namely what I am calling the moral hazard of implementing any program like this. And as we will see, that is going to be the biggest question we can answer. So let me go ahead and share my screen now and get my slides lined up. And here we go. Okay, first, some historical background on government involvement in student lending. It's basically a story of increasing government involvement in education, which is not surprising because it mirrors the government's growing involvement in virtually all walks of our lives. Government involvement with student loans started with the GI Bill in 1944, and it contained provisions for government loans to veterans. And the program had a big impact because eventually, partly due to this subsidy, veterans accounted for almost half of those attending college. This loan program was updated in the 1958 National Defense Act. In 1965, the government started guaranteeing student loans made by banks. Before this, bank loans were rare because students are pretty bad credit risks. But 1965 also gave us the Student Loan Marketing Corporation. It's SLM, used to be called Sallie Mae, actually still is. It was a federally chartered corporation that was founded to buy government-backed student loans from the banks. And this program took most of the loan risk off the banks, just like the mortgage-backed securities market still does for home loans today. In 1972, Pell Grants, which are just straight grants to low-income students, were instituted. In 1992, government direct lending started. And for a while, government direct lending, lending of government money, existed right alongside the private guaranteed lending that the banks were doing. In 2004, Sallie Mae lost its government charter, became a private corporation, and the subsidies were being cut back. In 2008, most of the private lenders stopped lending entirely because they no longer saw these loans as profitable at all. Because without the subsidies, which were decreasing, and with the pressures from the great financial crisis, private loans for tuition just dried up to a trickle, and that's where they are today. Finally, in 2010, under the Obama administration, all federally guaranteed student loans became direct loans from the U.S. government. No banks were involved in student lending anymore, and at least that's not true. Some banks still make private loans, but they have nothing to do with federal guarantees. And so basically the federal lending is completely at the helm. Today, you can see from this chart, from the Fed's data, Federal Reserve Bank of St. Louis, total college loans owed to the federal government today are now $1.75 trillion. That's with a T. These are loans made directly to college students by the Department of Education, as well as numerous other government agencies. And this total is growing fast. For example, in the last 15 years, the value of educational loans owed to the government has increased by roughly $80 billion a year. Now, that note is a net addition. So you have to take the additional loans made every year minus the loans paid off, and that still foots to $80 billion increase per year. Compared to, this is a big lending program. Now, compared to other forms of consumer debt, this government loan program is huge. It's you can see it's eclipsed, not only eclipsed the private tuition lending market, but it's also eclipsed just about every other kind of lending. Today, there's 45 million federal student loan borrowers, 45 million, with an average debt of about $30,000 each. About 6.5% of the loans are delinquent. That is, they're not paying on time. The typical loan payment is $200 to $300 a month. And just to give you an idea, the majority of U.S. college students have some kind of loan from the government. For example, in 2019, 55% of the class of 2019 took out a student loan. Now, one big reason this college loan program is so big is that college has become so expensive. It was not always this way, though. College was always a stretch, but it wasn't like it is today. And here I want to tell you some stories because I'm old and I remember. In the mid-1970s, I was able to get through Harvard Business School with my own savings, weekend employment, and a $5,000 GI Bill loan, which I was able to pay back pretty easy in my first job. At about the same time, two of my younger brothers, they're both a little younger than I am, were able to work their way through college in the early 70s. They worked part-time as plumbers, and it took them a few extra years to finish, but it was possible then, though it was difficult. Today, I don't think it's possible to work your way through college, quote unquote, unless you do it over a very long time. So today, students have to borrow money to pay for college, but why is college so expensive in the first place? Well, it's at least partly because of this profligate government lending program. College is expensive in large part because government loans are handed out like candy, and that increases the demand for college. Increased money spent on tuition increases demand for college, which drives up the price. Higher revenues at college, received by the colleges, encourages them to spend more on extraneous services like, rock climbing walls and new buildings. But of course, the higher tuition cost requires that the students then go borrow more. And so obviously paying it back has become a burden. Now, my wife is an example of college loans and kind of a victim of this program, of this so-called forgiveness program. She was on her own at an early age. She had no money for college. She worked full-time. She attended school when she could. She was juggling work and childcare and while trying to get an education. And so she also took out some educational loans, as little as possible, but she took some out and she paid them all back. And it took her 14 years to get a degree this way. She likes to say, lots of people go to school for 14 years, but most of them are called doctor. Anyway, so I call her doctor sometimes. But this chart here will give you an idea of how college costs have gone up compared to the cost of living. Over the last 30 years, while the average cost of living, according to the CPI, has doubled, the cost of tuition and fees at colleges has more than tripled. So, it gets more expensive all the time. And that spread between the two lines grows. And this is a longer-term chart that's even more dramatic. You note how the rate of increase in college, this is a chart that goes back to 1980. And notice how the rate of increase in college tuition took off right about the time the government took over the lending program. That's in the middle of the chart there where the slope of the line starts to steepen. So it's easy to see why college tuition goes up given the growing loan program. Just imagine if the government was willing to lend anybody money just to buy a car. And you just suppose they'll lend you money to buy a car, anybody, and you don't have to start paying it back until years from now. And you might not have to pay it back at all if there's a forgiveness program. What do you think would happen to the demand for cars? And what about the price of cars? The price of cars would go up. Car manufacturers would build more production plants to meet the demand. Maybe people would buy 3 cars instead of 1 or 2. And the government program would have to rise to meet that demand. So the higher the tuition goes, the more the student needs money to borrow to pay it, which increases demand, which drives up tuition more. This is a classic financial bubble. It's a vicious circle created by the government's unending, largesse. And just as an aside, this really did not have to happen. I saw a good article by Jason Riley in the Wall Street Journal recently, and he had some good thoughts. I'll quote, he said, "If Mr. Biden were serious about addressing the student loan problem, he wouldn't push to forgive debts at taxpayer expense. He would instead call for the privatization of student lending. And he would support legislation to require that colleges have skin in the game by paying some portion of the loans for borrowers who default." But here's Jason's best idea. Quote, auto manufacturers set up their own finance companies to help consumers pay for cars. Why can't colleges and universities do the same for potential students? Wow, good idea. For example, I could see Stanford with its vast endowment set up its own lending program and become responsible for the credit risk they take when they lend to students. Well, anyway, so that brings us up to the current state of the student lending program. The important points, I guess, to take away are that it's a huge program, completely dominated by government and growing out of control. Okay, so let's then go into how does this proposal of Joe Biden's work? What is it? Now, back when he was campaigning for president in 2020, Biden promised $10,000 in student loan forgiveness per borrower. And now he's announced that Americans earning less than $125,000 annually, or $250,000 per household, that's a pretty high number, can receive up to $10,000 in federal student loan forgiveness. If you're a Pell Grant recipient, that is, if you are a low-income person, you get to have an additional $10,000 in loans forgiven. Now, in addition, there's currently a pause from the pandemic, a pandemic decree on all federal school loans, and that pause would continue until the end of this year as part of Biden's program. And in addition, there's some other adjustments to pay caps on low-income people. But I should add that before I go on, that it's questionable if this program is even legal. It's kind of a unilateral decree by the president on money matters. It's not an act of Congress, which the Constitution requires for money matters. But Biden is trying to justify it under the so-called HEROES Act. And the HEROES Act was part of the federal government's increase of emergency powers following the 2001 terrorist attacks. It was invoked again during the pandemic, quote, emergency. And now Biden's trying to use this law as emergency aid for people with student loans. Emergency powers under the HEROES Act kick in when the president declares, unquote, national emergency. Of course, the Department of Education and others are delighted to continue the national emergency. But from what I'm reading, most lawyers outside the administration are saying that this is an illegal move. But we'll see. They've gotten away with worse. But now another legal issue is taxation. Debt forgiveness imparts a real economic value. When someone forgives your debt, that's real economic value. So it's likely subject to income tax, which would put kind of a damper on Biden's windfall plan. But anyway, all that aside, I suspect that Joe Biden does not even care if this decree is legal or not, or whether it's subject to taxation or not. I suspect that he's just hoping to gain favor for his party in front of the midterm election. We probably will not even know if this plan is going to fail or not until after the election. So there's no cost to him in making a promise that he can't keep, that he doesn't have to keep till after the election, and which, if it fails, he can probably blame on the courts anyway. It seems like a desperate move to gain popularity by a guy whose approval ratings are already in the toilet. But anyway, putting aside the legal and the tax wrinkles and all of that, assuming that Biden is successful in getting these loans nullified, who would benefit from the windfall? And we can see from this pie chart here that a solid majority of the 1.75 trillion in loans are owed by professional people with master's or doctorate degrees. And another 25% have bachelor's degrees. So the debt is highly skewed to people who are already most likely earning decent money, for the most part. Now this chart shows debt distribution by educational level, but how about by income level? According to an analysis done by the former budget director, David Stockman, the highest income 40% of households, that's those with incomes above $74,000 a year, owe almost 60% of the outstanding educational debt, and they make almost 75% of the payments. And by contrast, the lowest income 40% of households hold just under 20% of the household debt, and they make only 10% of the payments. It's almost the classic 80-20 rule. Now, that does not capture the full difference but in payment burdens, because a growing share of the borrowers are on what is called the income-driven payment plan, which requires either no payment at all or a very small payment as a percentage of their income. Well, the point is, I know I gave you a lot of numbers there, but the point is that the out-of-pocket loan payments are extremely concentrated among high-income households. On the other hand, very few low-income households are required to make any payments at all, explaining why the bottom 40% of the student loan households account for just 10% of the payments. So it seems clear that this is a bailout for the affluent. This is a bailout for the upper 40% of the income population, because these are the people who owe most of the debt. So they're getting most of the relief. There's no doubt that some poor people will get their debt reduced, sure. But this is a very expensive way to help those who need it, because it involves spending a lot on those who don't need it. So even if you do advocate relief for the poor with taxpayer money, which I do not advocate, by the way, this plan does not achieve that very well. Now, some on the left have said that reducing college loan debt payments will effectively reduce the cost of education. However, I think it's likely to have the opposite effect. And why? Because when you subsidize a good, you artificially increase demand for it while decreasing the incentive for the seller, in this case, the colleges, to lower their costs. So just to repeat, cheap student loans are one big reason college tuition has gotten out of hand already. So even from a left-wing point of view, this deal appears to be bad policy. It may help some poor people, but not very much. It subsidizes the affluent, and it will not lower college costs. So you have to ask, what is the motive? What is the motive for this plan? I would conclude that it's kind of a brazen attempt to buy votes before the election, mostly from an upper class or an upper middle class and professional group who are probably already leaning left, but may be apathetic about Joe Biden. Okay. All right. So there's the basic plan and what I think is the motive. But now let's pause and see if there's any questions or chats before I get into the sort of the hard money Jim economic questions about, is this inflationary? Dylan, do we have any? I don't see the YouTube screen. So do we have any chats you want to relay?
Oh, we have two super chats today. We have one from Kurt, so thank you, Kurt, and one from Duan Knight. Duan.
Well, thank you. No questions attached?
No, sir.
Okay, great. Thank you both very much for watching and contributing. Okay, so now let's ask the question, is this loan forgiveness program inflationary? And you may be interested to hear that Treasury Secretary Janet Yellen argued against this bailout on the grounds that with inflation that is being at a 40-year high, the cancellation of student loans would free up extra consumer spending and drive CPI prices even higher. That's according to the New York Times, which apparently has an inside to Janet Yellen. So even under Yellen's flawed definition of inflation, remember, she calls it rising consumer prices, but I don't think it's that. Even under her definition, this program's inflationary. I have seen estimates from some economists saying that this forgiveness program would raise the consumer price index by a couple of tenths of a percentage point, like 0.1 to 0.3 percentage points. Now, that is small potatoes. So I expect Biden saw that and thought he could ignore the inflationary effects. But of course, that's, like I said, a flawed definition of inflation, because as we know, inflation is an excess increase in the money supply caused by government action. Peter Schiff, who you might know about, he's an investment manager. He understands this and he analyzed it much better. In a recent Zero Hedge interview, Peter Schiff said, quote, "All the money that students are not going to repay to the government's just going to print. The Federal Reserve is going to print that money because this is like a giant tax cut for certain Americans, because the government is not going to get the money that it was going to receive from the repayment of those loans." And that's basically correct. The loan forgiveness program is inflationary, and let me explain why in my words. The government has this annual stream of revenue called principal and interest from student loans, from student borrowers. This is income for the government. It has the same status as tax revenue. It goes into the general pot of money for the government to spend. But now Biden says the students don't have to pay. So the government is going to lose maybe $30 to $50 billion in annual revenue that it would have gotten if the loans were being repaid over many years. So imagine you loaned money to someone and they were paying you back in interest and principal, and that would be a valuable asset and valuable income to you. And if you were living off the income and they defaulted on the loan, your income would vanish. It's exactly the same way for the government. The loan forgiveness program is loss of revenue to the government. But on the other hand, is government spending going to go down to match the loss of revenue? Well, we know the answer to that. No, not at all. So a decrease in income with no decrease in expenses means an annual increase in the deficit. The government could replace this lost revenue in several ways. It could increase taxes. It could increase borrowing. It could increase money printing, which consists of monetizing some of that borrowing. And it is this last, the monetizing of the borrowing, that is inflationary. This is the creation of money caused by the government. This is what was done under quantitative easing, as we have discussed often on this forum. So to the extent that increased deficit resulting from this giveaway is funded by monetizing debt, this debt forgiveness will be inflationary. It will result in inflation. So the answer is yes. Debt forgiveness is inflationary, but notice two things. First, the inflation effect is small compared to other inflationary programs. We're talking about 30 to $50 billion per year in lost revenue that might have to be paid for by inflation. And that's against a deficit of at least 1.5 trillion a year. So it's a tiny piece of the deficit. And second, it's not as if this kind of thing has not been done before. only bigger. This is a small fraction of other subsidies and stimulus programs, such as were implemented during the pandemic. Now, I understand why people are upset, and I understand why they concentrate on the inflation issue. Inflation's on everyone's mind, and this does add to it. So it's natural for outraged people to lump this into the inflation outrage box. But as we're about to see, inflation is not the whole story here. Inflation, I don't think, is the real reason people are so outraged about this. Now, in the Peter Schiff interview I alluded to, he also pointed out the moral hazard inherent in this bailout scheme. Moral hazard means a lack of incentive to guard against the risk of taking on debt because people are, protected from the consequences. Here's what Schiff says. He says, quote, "Remember, the only reason we have all these student loans is that the government provided them or guaranteed them. The only reason college is so expensive is that the government provides so much money in the way of loans. But now that they start forgiving loans, students are going to borrow more money than ever before because the colleges are going to tell the students, hey, who cares how much money you borrow for college? You're not going to have to pay. Not going to have to pay back anyway. So we're going to double your tuition, and don't worry, maybe we'll throw in a free car." So, Schiff can be pretty cynically funny sometimes, but he's articulating the real reason people are so outraged by this program. It's not the inflation effect so much as the moral hazard that results. Now, exactly what do I mean by moral hazard? It's a term that's often used in insurance, and it gained popular usage during the great financial crisis when our government bailed out the banks. Moral hazard is the risk that a party to a contract has not entered into that contract or agreement in good faith. So the risk is that future borrowers will continue to borrow more money thinking they will never have to pay it off. And they have good reason to expect that. Future borrowers will expect to be bailed out just like the present ones, and the bailouts are getting bigger. So why wouldn't they think this? Yeah, just borrow to the hilt from the government, you'll never have to repay. That's exactly what happened, though, in the pandemic loans. The government said in advance, here, borrow this money, hundreds of billions of dollars, and wink, wink, nod, nod, we will forgive the loans. And the huge inflation unleashed by this policy, which we've talked about a lot in this forum, is only part of that story. The lesson of the bailout is, don't pay, you're a sucker if you pay. Everybody's going to borrow the money with the expectation that the loan's going to be forgiven. So we can start to see why so many people who do honor their loans and their commitments, college and otherwise, are outraged. Why did they bother to honor their debt if the government's going to make someone else pay, either through direct taxation or through inflation? Many are just thinking, many of those who were honest and paid back are thinking, I paid twice, once to pay off my own loan and again to pay off someone else's. And just to go back for a minute to the example of my wife, she was accepted to a prestigious Ivy League college, but she declined to go because she did not want to incur all that debt. Others who did that and took on the debt are now getting their loans forgiven. And of course, you can imagine my dear wife is outraged, as she should be. Now, this is a bad thing. This is a very wrong thing that Joe Biden's trying to implement. But it would be a mistake for current conservatives to just blame this kind of thing on liberals, because this bailout is no different in principle from what the Republicans did in 2020 and what the Democrats did in 2021 with the various COVID bailouts, which were huge in their economic impact. And what about the moral hazards of the hundreds of billions of dollars in loans to anyone with the understanding in advance that those loans would be forgiven? That's what happened during the pandemic. Doesn't that also make a mockery of true borrowing and undermine the honor of those who lend and borrow legitimately? So I think there is a more principled way to think about debt forgiveness at public expense, whether that forgiveness is being funded by taxation or by inflation. Yes, we should be morally outraged, but not just because of the narrow idea that our money is being diluted by inflation. We should be outraged because this college loan bailout is an example of pure plunder, which is the violent and dishonest taking of property to distribute it to someone else. Now, I actually like that word plunder. It's an archaic term, but it's very accurate in its meaning. It means to rob by open force, as in war, or to take wrongfully, as by pillage or fraud. That's a definition. This loan bailout is an obvious and in-your-face insult to those who paid off their loans in good faith. And it's very cynically partisan as well. It literally says to the beneficiaries, here, take this cash benefit from those who are unwilling and or unable to pay for it. They'll never notice, and they're probably not going to vote for me, Joe Biden, anyway. So, I mean, it does make you sick. More broadly, though, all inflation and most taxation, not all, I think, but all inflation and most taxation are forms of plunder. Taxes that take from some people without their consent and where that money is used to reward others, that's an obvious form of plunder. But inflation is a special kind of plunder because it is less obvious than forcible taxation. And it's one of the reasons I'm so interested in money creation. Inflation is a kind of embezzlement caused by government caused increase in the money supply. Increases in the money supply by means of the exchange of nothing for something valuable diverts real wealth away from wealth creators and toward holders of the newly created money who created nothing of value themselves. The holders of new money, in spending that money, divert goods to themselves without producing any goods themselves. And the effect is the same on those who receive a windfall of debt forgiveness. They receive an increased claim on real wealth, giving nothing in return. So the numbers in this particular bailout may be small, but the fraud and the theft are obvious. They're very obvious, and they're out in the open for all to see. And that's why I think this action outrages us so much. It appears, just as Frederick Bastiat warned, that Joe Biden and his predecessors, and not just the left, have created a legal system that authorizes plunder and glorifies it with their moral code of altruism. But notice that Biden thinks that he can get away with it because he's just going with a well-established trend. He's just following the lead of his predecessors. Both Republican and Democrat Congresses appropriated money to give away during the government's pandemic, pretending that this money was some kind of gift from the government. In fact, it was a redistribution of wealth from the masses to everyone who happened to be in a special group. These were businesses and individuals who knew how to cash in on the scam. It was complicated by the fact, of course, that government itself, through their lockdowns and other draconian restrictions, caused almost all of the economic damage during the pandemic. So once again, and I've used this analogy before, the government is the arsonist who sets the fire. And then by a process of inflation, it pillages the entire population with those ill-gotten gains, and it rides in with stimulus to act like the hero fireman to extinguish the inferno that it's caused. So our politicians are not merely arsonists who pretend to be firemen. they're stealing from the people the very resources they use to put the fire out. Similar things happens with student loans. The government subsidized and inflated college tuition by providing unproductive loans, and now it wants to ride to the rescue with a loan forgiveness program at the expense of those who did not benefit from either college or from the loans. Are you outraged yet? I suspect you are. All right, so I'm articulating a feeling here that most people feel but do not express verbally, but I think they should, and so should you. Okay. That was a good screed, wasn't it? Okay, Dylan, let's pause here. Let's see, we still have time. I have actually prepared a little bonus round today with, I have something additional I can add, but if there's any questions or comments, let's get to those first.
So we do have a couple of comments. One from Bonnie that says, it comes from technological advances that haven't been invented yet. What are they counting on? I believe that's alluding to the title.
Technological advances. I'm not sure I understand the comment. What do you or can you get a little clarification on that, Dylan? What are the technological advances we're talking about? I'm
not sure what the exact context was. That was very early on in the show.
Okay, that came from early on. You know, I need to figure out how to take these questions in real time so I could. I'm sure Bonnie has an excellent question in mind. I'm sorry I don't understand it.
And
anything
Chuck
else?
E. Cheese has a comment that says,
"Ooh, Chuck E. Cheese."
Chuck E. Cheese himself.
All right.
They need to go back to 2005 when students could default on college loans, forcing banks to consider who they give the loans to and why, as it was the case for decades. Nearly directly giving money to your voters is pretty wrong. Why doesn't the next president by executive order give $10K in debt forgiveness to people who've owned a gun for over 10 years?
Well, I mean, you're pointing out the highly perverted lack, or I started to say perverted logic, the lack of logic in doing all this. I mean, there is no end to, no conceptual end that you can think of that would bring an end to this. You can imagine loans, college loans being extended to, I don't know, to everyone, whether they went to college or not. Oh, maybe you will go to college, have some money. This is very pernicious, and the more it grows, the more obvious the pernicious nature of it becomes. Okay,
and
well,
Bonnie did go on to clarify just now that her comment, technological advancements that haven't been invented yet, is referring to where the money will come from. In the sense that somebody someday.
Oh, so maybe Bonnie is saying that the world is hoping on economic growth from technological advancements that will increase production enough so that we won't see the terrible effects of inflation. Well, I think some people hope that, but that puts the cart way before the horse. You never know about that. So, not to mention the fact that in this collectivist system they're creating, you won't see much technological advancement. There won't be much incentive for it. Okay, do we have just? Yeah, we have a few more minutes. So I wanted to have a little fun. It is fun for me. I don't know about you guys, but you might recall, put this in the odds and ends and Fed follies department. You might recall some weeks ago that we were talking about how the Fed leaks its policy through this guy, Nick Timiraos. Every time Nick writes something in the Wall Street Journal about the Fed's intentions, the market reacts, and he always seems to be right. And it sure seems that Nick has some kind of direct line to someone at the Fed because he always has the right answer. And it appears that he is the Fed's preferred channel for leaks. And that's why, if you recall, when we talked about him before, he is known on Wall Street as Chairman Nick. But recently, what I find interesting is that recently the Fed, a couple of weeks ago, said that it was abandoning forward guidance. You might recall they said they had three legs to their policy. One was, interest rate control. Two was monetary policy or, open market operations. And the third was forward guidance, where they would try to signal by their communications to the market what they were going to do and therefore let the market anticipate. But 2 weeks ago, they said they were abandoning the third leg of the stool. They were abandoning forward guidance as a policy tool. And instead of telling us what they're going to do, Chairman Powell said the Fed was simply going to react to the data as it comes out. So they get economic data, they make their move, but they don't tell us well in advance. And this change was designed to convey less inaccuracy and better transparency. But my question is, did they really abandon all forward guidance like they said? Now, here's what Chairman Nick wrote on September 7th. Now, they've allegedly abandoned forward guidance. The Federal Reserve appears to be on a path to raise interest rates by another 75 basis points this month in the wake of Chairman Powell's public pledge to reduce inflation, even if it increases unemployment. Fed officials have done little to push back against market expectations of a third consecutive 75 basis point rate rise in recent public statements and interviews ahead of their September 2021 policy meeting. So Chairman Nick here signaled a third consecutive 75-point basis hike coming on September 21, and the market reacted. And this chart here shows that the reaction was swift and it was immediate. I don't know how well you can see that, but what this is traders on Wall Street, interest rate traders, buy and sell interest rate futures as bets on levels of rates, including the Fed funds rate, the short-term rate. And the sum of the bets that they make conveys a measurement of the probability of a rate hike. So if you probably don't see this too well, but at 6:32 a.m. on September 7th, the odds of a 75 basis point rate hike were at 72%. At 6:33, when Chairman Nick released the story, the odds went up to 92%. Obviously, the Nick Timiraeus hotline to the Fed is still open. Now, I just mentioned this because we talked about it before, and it's kind of amusing how government officials operate. Anything but real transparency seems to be their preferred method. They're very untransparent, it seems to me, about their so-called new transparency. They still prefer leaks to preferred members of the media, despite abandoning quote unquote forward guidance. So one thing we know is we can stay tuned for more Fed follies, as the worldwide recession unfolds. And I do think it's a worldwide recession unfolding. All right, let's call it a day. You can reach me on Substack at Hard Money Jim. That's the website there. I did a two-part series, Money Creation, Who Cares, on here on video. I'm turning that into three essays written in a little more formal manner. And when you write it, you can formulate your thoughts more precisely, which is what I wanted to do in that case. So I finished part one. It's on the Substack. You're encouraged to it. And part 2 and 3 will be coming out in the next several weeks. All right. Let's call it a wrap. That's pretty good timing, I guess. Got about 10 minutes left, but we can call it a day unless there's any more questions or comments.
No, sir. We got to them all.
Okay, thanks everybody for watching and listening, and I will see you next week. Take care.